here's the email address to request it, help@getsetup.io. And we will be live streaming this on Facebook Live, I believe. So if anybody is watching us from Facebook and in the future you want to get into classes and be able to ask questions directly and interact directly, you can do it through the Get Set Up website and portal. And typically we don't talk about any products in this class, but it may come up with some questions. So just to level set with everybody, Get Set Up does not pay nor get paid to promote any specific products that might be mentioned during this class. So with that, our objectives today, we're going to talk about the different money buckets and how they relate to investing. We're going to talk about some basic investment strategies and their levels of risk. And then we're going to summarize with some investment thoughts. So I just want to make sure, as we said, this is not an advisory course, nor do we advise on investments. It is an informational class only, and I am not an investment advisor. So I just want everybody to level set on that. So with that, I'd like to turn it over to any of you that want to say a few words about yourself so we can sort of know who's on with us, and then any particular things you want to make sure we try to cover. That would be great. So anybody want to hop in and be the first? All right, whoever's laughing with their mic on, you get to be first. I can't tell who that was.
My name's Greg. I basically, I was working for an annuity company doing customer service. I took some time away to improve some. I've spent a lot of time in customer service, but I haven't had a significant amount of time working specifically with the Microsoft products, and felt like I needed to get some additional skills. And I'm just weighing my options on whether I want to keep retired or go back to work.
All right, Greg, thank you so very much. Anybody else want to say a few words about themselves?
Hi, I'm Cindy Spencer. As you can read from my name there, I just want to understand a little bit more about, investments. I have a lot of investments, and I also work for I did some consulting work for a financial planner for a while. So I just wanted to see what this class was about and maybe get some tips or pointers, that could help me figure out if I want to invest any money or if I want to just save it instead.
All right. Thanks for joining, Cindy.
I'm Elizabeth, mid-70s, and would like to know if there's anything that a small investor could do in this age.
All right. All right, sounds good. Elizabeth, thanks for sharing with us, and we'll see if we can talk about some of those things. All right, so let's go ahead and get started. And I do like these classes to be interactive. Obviously, you're more than welcome to ask questions on chat, but don't feel like you're going to slow down or interrupt. If you just want to unmute yourself and ask questions directly, that's great. We will talk about a few ideas that maybe aren't real easy to comprehend. So please slow me down or stop me and ask questions as we go. And to help me out and make sure that we are explaining the concepts correctly, I'm going to have what I call a few pop cash questions. They're just questions that we're going to have a little fun, see who can answer them first. And they're going to relate to what we just talked about in the prior screen. So for the pop cash questions, I will ask that you do answer those in the chat so we'll know who answered it correctly first, and we don't have any fun. And so the pop cash questions, I think we all understand this, but they are not legal tender. It's just a little game we have just to stay focused and make sure that we're all moving forward on the same page. So I hope you enjoy that. So the first thing we want to talk about are different money groupings for investors. So the first group of money is what most investment experts call short-term money. And that's usually money that you will need within the next 2 years. So typically, most of us are probably in retirement or transitioning to retirement or thinking about retirement, as Greg is. And so you should consider your short-term money that you're going to need for within the next 2 years. So typically, the classic example is if we're retired, most of us, if we do have some money invested, we are taking money out to live on. Whatever doesn't match our Social Security, pension, and other expenses that we may have, we're taking some money out of our investments. That's why we've been working all of our lives. That's why we've been investing money. So specifically, that short-term money you're going to need in the first 2, some experts say 3 years, is considered that short-term money, and that should be invested, according to most experts, very conservatively. And that means basically in cash or similar similar investments, such as a CD, a certificate of deposit, or a money market. You should not, according to most experts, invest that short-term money that you're going to need within a couple of years in any stocks or bonds. It's too risky, and that they may move up or down in spurts, and you won't be able to feel comfortable, especially if the stock market goes down and you need to take money out. So that is a short-term money, and generally you should not invest this in either stocks or bonds, according to most experts.
Okay, so Phil, I have a question. On the short-term money, now, I'm transitioning into retirement, so that's my status. And we used to I used to have to be prepared. First, it was like 3 months worth of salary in case something came up, 6 months, then it went to 6 months worth of salary. Is there any guidelines for going into retirement, like how much money you should have, in case?
Right.
In case of an emergency, or in case of something happening? I mean, we are pulling from at this point, I think, we'll be pulling from our investments and also possibly getting Social Security. So is there a formula for how much you should have, ready cash?
Yep. This in essence, sort of, as you go into retirement, Cindy, this short-term money, this 2 years of money, really sort of replaces your emergency fund in all practical purposes. So in essence, what this is, it's a combination of things. We have, now that we're in retirement, most of us have a bigger nest egg than we need for a couple of years. So the emergency fund, while we're working, is in case something happens in regards to either we lose our job or some big expense, unplanned expense comes. So in essence, we're replacing this as we move into retirement, because we are now, our income is really our retirement plus our pension plus our Social Security. So Social Security is we know it's there. It's gonna be there, next year. So you don't have to worry about losing your job. In essence, you don't have to worry about losing your Social Security next year, over the next 12 months. Our pension, if we have a pension, if we're lucky enough to have a pension, we know that's guaranteed. It's going to come in every month. So we don't have the risk of losing our income.
I see what you're saying.
Right. So the income that we are going to take out, the income we need to match our expenses, is that short-term money. And in essence, this is what we're talking about. So your emergency fund, so to speak, in their non-retirement world, is sort of now your short-term money, and you should have that available in non-risky investments, which is basically cash type investments like we talked about a minute ago. So does that
So
sort of help?
you're saying whatever amount you're budgeting every month, you should have 2 years worth of income then, based
Right.
on, okay.
Yeah, but the short-term money should be, Cindy, after you figure out, let's just for an argument's sake, let's make an example. Let's say you're living on $5,000 a year. Your Social Security is $2,000 a year. Your pension is $1,500 a year. So you're getting $3,500. I mean, I'm in a month when I said year. You're getting $3,500 a month now. So you need another $1,500 a month coming out of your investments in this example. So that $1,500 a month times 2 years is that short-term money. Does that help?
Thank you. Yep, thank you. That cleared it up.
All right. Any other questions on that from anybody else? Okay, so your middle investments are usually considered by most investment advisors to be somewhere between 2 and 7 years. And this still should be invested relatively conservatively, but it doesn't have to be quite as conservative as that. So you might be able to invest in some very conservative stocks, and or basically most of us should probably be investing in mutual funds. So in some conservative stock type mutual funds or bonds. And that's for the money that stretches from about 2 years to 7 or 8 years. Then most investment advisors say that the money that you're not going to need for 7 or 8 years and beyond can be invested in basically investments are a little riskier. We're going to talk a little bit more about what that means in a second. So this is sort of bucketing for retirement, how we want to look at the money. Now, when I say they need to be in different types of investment, that does not mean they need to be in different investment accounts. You just are investing them differently. They can all be in the same account, all with your same investment advisor. It just is they should be invested in differently from each of these. So the question I have down here at the bottom is, how do you calculate your short-term needs? And that's exactly in trying to help Cindy answer her question. That's what we talked about using that example that we just had. Your short-term needs are the $1,500 because your other $3,500 comes out through the pension in our example and Social Security. All right, so we're gonna have a quick pop cash question. So get ready. This is a pretty easy one, I believe, but get ready with your keyboard. And so the question is, how many years out does short-term money generally go? So we just talked about that. Just go ahead and answer it in your chat, and we'll see who is the first one to get it right. All right, so Viv says 2 years, and she is correct. So everybody's getting it right, but Viv, I guess I don't want to say it's Vivian. Viv was correct. So she's the winner of the first round of the Pop Cash. We're going to have 2 or 3 more questions. So we'll see if she continues to lead in this or if somebody else does. So Viv, congratulations and thanks for round 1. All right, so now let's talk about stocks and bonds, make sure we're all on the same page as to what they are and how they compare from a risk standpoint. So bonds are either a government or a business, a company borrows money under an agreement to pay you back a rate of interest. So typically a government, so the US government is an example of somebody you can buy a bond from. You can buy a bond from literally thousands of companies out there. So somebody like Google, you could buy it from. Somebody like General Electric, you could buy it from. Some small company you've never heard of will also have some bonds that are available. So government bonds are generally considered to be safer than most company bonds. And the US government is considered to be the safest government in the world to lend money to. They have never not paid back. So because of that, the US government can offer you a lower amount of interest because you are sure you're going to get your money back at the end of the loan. So as I say here, generally you get your initial investment back if you hold the bond until it's over. Matures means when it's over. So bonds can be anywhere from 2, 5, 10, 15, 20, 40 years out that would happen as to when they actually mature. Now, most of us should probably not invest directly in bonds, but should invest in probably mutual funds that invest in bonds or electronically traded funds. I'm not saying if you don't already have bonds and you're working with an investment advisor or you truly understand bonds that you can't have individual bonds, but most of us that are probably involved in this class should work through the mutual funds with their investment advisor or electronically traded funds. We're going to talk about both of those in a few minutes, what they are, what the differences are, what the similarities are. So as the company isn't as stable and has more financial issues, the amount of interest that they are going to have to charge to get a loan from you is going to be higher. So typically, if you are looking at different companies or governments for a rate of interest, usually the higher the rate of interest, the riskier it is. They are more unstable. And the risk involved in bonds is if that company goes out of business before your bond is over, you will not get back that money you lent them. You would get back interest every month or every quarter or once a year, however they pay interest while they're still in existence. But if they do go out of business, then you do not get your initial investment back. So that's the reason why most of us should not invest directly in an individual bond, because we don't have the ability to do all the proper research to find out exactly which companies we should buy bonds in. And that's why I suggest a mutual fund or an electronically traded fund. So stocks, on the other hand, you are a part owner of a company. So if you buy a stock, you have bought an interest in that company. They do not have to pay you any interest or dividends. They may, a lot of good companies do, but they don't. So you are buying ownership in that company, and you believe that at some point in the future, that company is going to be worth more than what you bought it for today. And that's where your profit would come in when you sell that stock. So just like bonds, most of us should not probably buy individual stocks. We should buy them through a mutual fund or electronically traded fund. So questions on those two? The differences or the similarities? All right, so now let's talk about the risk between the two. So the stocks, as we talked about, offer no guarantee of return, while bonds do give you a set rate of interest that they're going to pay you. So generally, bonds are considered less risky than stocks. But there is still risk in bonds, because if the company goes out of business, you're going to lose that initial investment that you have. So I don't want you to take away from here that that there's no risk involved at all. They are just generally considered to be less risky than stocks because of the interest you're getting every month. And if the company is still in existence, they will pay you back your initial investment at the end of the loan period. So there are other investment categories, such as things like oil or gas. There's things like Bitcoin, all kinds of different investments. They're usually called commodities. There's also real estate. You can buy companies that invest literally in real estate. There's all other types of investment categories besides stocks and bonds, but they really are outside of the scope of this group learning we're going to have. They carry a lot more sensitive issues, and you really need to you really need to investigate those a lot more. And also, most of the research we're going to talk about going forward looks at stocks and bonds and looks at those two. So if you do have an investment advisor and you have some other types of investments, you're comfortable with them, understanding what they do and how they do it, that is fine. I'm not saying don't be in those. Just for this class, which is a very basic general class, we're going to stick with stocks and bonds, and then that money that we talked about, that short-term money that we talked about. All right, questions? All right, we'll have another podcast question here real quick, so get ready. This one, again, is not too difficult, so I don't believe. We'll see in a second. So what type of investment pays their investors a set rate of interest? So we talked about that a second ago. Whoa, we got that one really quickly, so we know what the answer is. So Jody Lee says bonds, and she was the first one. Everybody's getting, like I said, this was a fairly easy question, but Jody Lee, Viv tried to win that one too, but she came in second. So we got a good competition going here. And we'll have one or two more questions, and we'll see if somebody is able to break through from these two ladies. I'm just writing their names down so we know who won them. So thank you so much, everybody, for participating in this. All right, so this is really the main screen we're going to spend most of our time on, and this is where we're really going to talk about, sort of summarize everything we just talked about. So this is the example of the risks that we're going to have. So first, this information comes from Vanguard. So Vanguard is a big investment company. I just picked them because they have a lot of data, and it's real easy to read their data. So this information does come from Vanguard. So what we're going to review is 94 years of history from 1926 to 2019. The 2020 information wasn't available when I checked on this recently. So we're going to look at 3 different classifications. This is called your asset allocation, which is how much you have in stocks and how much you have in bonds. So remember, we said that stocks are riskier generally than bonds. So this first portfolio we're going to look at is 30% in stocks and 70% in bonds. The second we're going to look at is 50% in bonds and 50% in stocks. So 50-50 allocation, half in each. And the third allocation we're going to look at has 70% in stocks and 30% in bonds. So we understood from earlier, stocks are generally riskier than bonds. So this is riskier than this portfolio here. As you can see, they have the opposite amounts. So now let's talk about the average annual return. So this is how much each year for these 94 years on average, how much each of these different type of investments have returned, how much they've gone up. So if you're 30% in bonds, 70% in stock, I'm sorry, the other way around, 30% in stock, 70% in bonds, on average for these 94 years, this investment has gone up by 7.2%. So if you look at the 50-50 combination, this is riskier. There's more stocks, and that is indeed true. We said stocks are riskier, but that means that they've gone up more. So on average, they've earned 8.3% per year, this combination of 50% of your portfolio in stocks and 50% in bonds. So if you have 70% in stock and 30% in bonds, that's riskier. And indeed, that risk, it's paid off. You, on average, annual return is 9.2%.
Philip,
Yes.
can you give us an indication, like looking at the worst years, for instance, I go, 30 minus 31%. But what I'd like to know is, were there several years in a row that were all minus 25, minus 35? Or is it up and down and up and down?
It's generally up and down, up and down. I actually do have a graph buried in the back, which I'll pull up if you don't mind, Jody Lee, at the end, and sort of answer that question in a graph format. Is that,
Please, thank you.
fair?
That,
Okay.
it makes a big difference if it's some general slump everywhere, or if it's just a one time and then it's going to get bigger next year.
Yeah, I initially had this graph in the presentation, but it seemed a little bit too complex to follow the graph itself. But yeah, so I'm going to have to change this so I don't show the punchline so fast, for you. But you're looking ahead, which is fine. I just want to sort of go through it slowly for everybody so we understand.
All
So
right,
now the
thank you.
best individual year, as you can see, if 30% in stock, the best individual year of these last 94 years has gone up almost 29%, 28.7%, a nice, big, solid increase. That's the best year. If it's 50-50, it's gone up 36%, just over 36%, their best year. And 70% in stock, it's gone up 44.4%. So to Jody Lee's point, if we stop looking here and we ignore these last 2 lines, it's pretty obvious. All of us want to have more in stock, less in bonds, because we're going to make more money is what it looks like. So now comes the reverse side of that coin, and we're going to talk about the worst year of all the same portfolio. So if you're 30% in stock, the worst 1 year has been, it's went down 15%. If you're 50-50 in stocks and bonds, the worst year is gone down 23.5%. And then if it's 70% in bonds, I'm sorry, 70% in stocks and 30% in bonds, it's riskier. You can see it's gone down 31.6%. So what we're saying is, when it's a good year in the stock market, it's better to have more invested in stocks. But when it's a bad year, that the more you have in stocks, the more it's going to go down. And as we get older and as we start, so if we're 25 years old and we're just starting in investing and we're investing for retirement, we have 40 some years probably to be investing. And if the stock market goes down 1 year, even substantially, we have plenty of time to have many other good years, which is sort of the question that Jody Lee asked. But as we get older and closer to retirement, and more specifically in retirement, it gets riskier to have more in stocks because of the chance that it may go down. So this number right here is just saying that if you had $1 million on January 1st of this worst year, you were invested 70% in stock, when that year ends, that $1 million that you have is going to be worth $680 some thousand. So in 1 year, you're going to lose over $310,000. So can you afford that, both financially, and more importantly, can you afford it emotionally? You have to be able to sleep at night. You don't want to take more risk than you can handle, because the worst thing that's going to happen is usually after a bad year or two in the stock market, they're going to start going up again. And if you sell because you are panicking because you're having a bad year, it's very hard to go again and start buying shortly thereafter. So you're going to lose a lot of money and you're not going to get the uptick later. So then the final line in this graph just shows the number of years with a loss of these last 94. So 15 of the 94 was down here. And this one, 18 of the 94 were down years, and here 23 of the 94, which all makes sense, right? When the stock market goes down, if you have more in stock than in bonds, you're going to go down more. So when the times are good, this is great. When the times are bad, it's better to be more conservative. So this is called your asset allocation, is what your investment advisor will call it, how you've allocated your stocks and your bonds, your investment portfolio. So this is the biggest thing for us to understand, that the more stock we have, the more risk we have, both in a good market and in a bad market. So what other questions do we have regarding this table?
So I have a question that I'm not sure you can answer, but it's just something that I'm looking at this chart. As we transition into retirement, of course, we're going to be at a higher, of course, we're going to be at the higher return rate as we start into retirement. So as we continue along the retirement path, is there anywhere, I don't know if there's any charts or recommendations. I mean, yes, I have a financial advisor I don't always agree with, but, but is there anywhere that recommends like where you should be depending on, how old you are, basically?
Right. So your investment advisor, especially when you first hook up with this person, they're going to ask you a lot of questions, some very personal, but they're going to have a table of questions that they ask everyone based on their company. And this is what they're going to do to help you help determine what your risk appetite is, how much of this you can do. So they're going to ask you questions like, if the stock market were to go down 15% this year, what would you do? Would you sell all your stock? Would you sell some of your stock? If the stock market were to go down 30%, what would you do? So they're going to ask you a series of questions. Each company has their own questions that they've developed, and this is called your risk portfolio. So from that, they're going to say, Cindy, by having you answer these questions, it is our opinion that you are a moderate type of investor. So this is sort of considered a moderate, the 50-50 is considered the moderate thing. So they're going to suggest that you're somewhere in that 50-50 range. It could be 40-60, it could be 60-40, but somewhere in that general range. And then every few years, they need to re-ask you those questions, because now as we do get older, we may, our thought process may change as to how much risk we can tolerate. We're getting older. Usually we get more conservative in our thoughts. So your risk portfolio may go down as you age, to try to answer your question, Cindy, which would mean less in stock and more in bonds. But is it something that should change every year? Probably not. It's 5 or 7 years, maybe you start getting a little bit more conservative, and maybe even a 5 or 10% shift between these two. Again, these are just numbers that are classic numbers. You can have 45% in stock, 55% in bonds, or the opposite, or you can have 75% in stock, 25 in bonds. These are just three sort of classic examples. This is sort of considered a aggressive type portfolio. This is sort of a medium type one, and this is a conservative type. So it depends on you, but most experts will say that as you do age, you're going to get a little less riskier, meaning less in stocks than you had before. But if you start here, going down to 60-40 may be right for you in a few years. While if you start here, you're going to go down from here. So it is very customized to each individual and where you start, so to speak.
But I also think that it probably depends on the amount of money you have, and then the amount you take out, and how the stock market has been been acting, and
you're
all those sorts of things.
Yep,
Yeah,
you're
so I think
absolutely
those
right.
have to come into play too.
Yep, and that's why I'll talk about the end, but I can talk about now. An investment advisor, a good investment advisor is worth their weight in proverbial gold, and they're going to help you and hold your hand. And the biggest thing a good investment advisor is going to do is make sure you don't panic and you don't sell when the stock market's going down, because more than likely you're not going to get reinvested, and you're going to lose all that money and never have a chance to make it back. So they are very critical, and that's why as your life changes, you need to talk about your investment advisor. Now you have 4 grandkids, and you want to help fund their education versus having one. When you talk to them last about this, that makes a big difference, because now you want to take out more money now as opposed to saving it for later. All those things come into play. So you're exactly right, Cindy.
And I also, one other thing, I imagine that you could, if you wanted to know what kind of an investor you were, you probably could find some stuff online. I don't know if you have any recommendations, but I bet there is stuff online to try to figure out where you're, whether you're conservative or aggressive or.
Right. So even, some of you may have heard of the nickname of robo advisors. These are companies that basically do everything via the computer, and you're not necessarily dealing with an actual person. And these are, mostly younger people seem to like this type of investment more than older people. And now most companies have a combination. But even with a robo advisor, the first thing you do when you want to sign up is they ask you those same 7 or 8 or 9 questions about your risk appetite. And then they say, based on this, we think you should invest approximately 50% in bonds, 50% in stock, or whatever your appetite is. So yes, there are a lot of, and you can go into Vanguard, any of these companies, even if you don't have money invested in there, and be able to answer some of those questions and get an idea of where you are. Yep.
Okay, thank you.
Sure. Jody Lee, if you guys will just let me run through, and we're gonna see. So this is the screen I was talking about. Jody Lee asked about, what year. So what this does is, this isn't all the way back, but this is from 1980 through 18 or 19 here. Sorry, I got some things on my screen. So it's 15 through 2017. So this is showing you what the stock market did, how many years it went up, how many years it went down. This is obviously a shorter period of time, from 1980. So Jody, this is the one I was referring to that I had back here. So not only does that, oops, sorry. show us that. It also shows us how far down the market was or at some point during the year. So, you know, a good example might be, so this year, at the end of for the year, the stock market was down. This is just stocks now. This is not bonds. The stock market was down 23%, but at some point during the year, it was down 34%. So, you know, Jody, to your question, here's 2 years in a row where at some point during the year, the stock market was down 30% or more. Now, at the end of the year, it was down 13 and down 23. And then the good examples the following year, it actually, for the full year, it went up 26%, but at one point it was down 14%. So does this help that question you asked, Jody Lee? This is the example that I have that sort of helps you see the up and down of the market itself.
This is exactly what I wanted to see. Yes, thank you.
Yeah. All right. It's a little bit
Love
complex.
graphs.
So I usually don't show it because it's got a lot of numbers in there, but this is the kind of thing that you can look at. So I actually got this from JP Morgan asset managers. I went to one of theirs. Again, I'm just looking for different things. I don't endorse any of these companies or not endorse them, but this one is by JP Morgan. This is their data that they have. And yeah, so that helps you sort of see the ups and downs. And more importantly, what I like about this, it tells you how far down it was at some particular point in the year. You know, a good example was this is about 87 or 88. The stock market was up 2% for the full year, but at one point it was down 34%. And if you sell here, and you can see the next three, basically it goes up like crazy, you know, 4 of the next 5 years, if you sell when it's down 34%, you are not going to get that money back, so to speak. And that's why the investment advisors and, you know, why they say you should not have too much in stock if you can't stomach it when it goes way down, because if it does, you're going to panic and you're going to sell at the exact worst time.
I just had a comment. I'll bet that 49% where the stock market was down was 2008, okay? Because I lived through that one.
Yeah, there's a couple of bad years in the middle of the year where it went bad. That's the whole thing. Even though the
So,
stock
yeah.
market, based on past history, has gone up more years than it's gone down, you know, there's no guarantee that for 2 or 3 years it won't go down in a row. And even on years where it ends up not doing too bad, in the middle of the year, there might be some stomach churning, some sleepless nights. And we do not want to have sleepless nights because of our portfolio when we're retired, especially. So we want to make sure we're not overly burdened on our stock percentage of our portfolio. So a couple other investment things to talk about. Age, we've already sort of talked about that, but that's key. And then your asset allocation, that's exactly what this is. This is called asset allocation, 30, 70, 50, 50, 70, 30. These, as you can see, I think are some of the most important considerations that we have. You know, how long until you need your money? We talked about those 2 years that you need money, but again, you know, I'm just sort of making this up with Cindy, since she sort of asked the question, you know, maybe at this point, she has a couple of grandchildren and she's expecting a couple more, and she wants to, you know, invest some of that money in their college education fund. So she knows that she's, you know, some of this money she's going to want to have in the next 10 or 15 years, as opposed to for her retirement, which probably will last another 40 years. So, you know, some of the money she's going to want it sooner than some of the others. So that's what she needs to tell her investment advisor so they can properly invest it. It's not your whole chunk of money necessarily that's going to go for retirement. So there are different costs, different types of fees for different investments. And we're going to talk a little bit more about that. Your mutual funds and electronically traded funds have different fees and expenses. So the more, basically, in a nutshell, the more you pay in fees, the less your return is going to be, right? So the fees are either commissions that you pay your broker and or the fees to actually run and manage the mutual funds and the electronically traded funds. So you just need to understand what the fees are and feel comfortable that you're getting your money's worth from the fees. Again, like I said, a good investment advisor is definitely worth paying for. You just want to understand how much you're paying them and how you are paying them. Another, another consideration is whether your money's in a tax deferred account. So things like IRAs or 401ks are tax deferred accounts. You have not paid taxes on them yet, but when you withdraw money, the government is going to have you pay taxes at that point. So that those investments are slightly different than your regular investment account, which you've already paid your initial taxes on the investments. And on those accounts, you're only going to pay taxes on any profit that you make at the end. So again, this just summarizes what I've talked about a few times already, is make sure you understand your investment advisor's philosophy and expense structure, right? They should really understand your philosophy because they're investing your money. But most advisors really have a particular flow that they do. Some specialize on younger people, some specialize in retired people, some specialize in people that have a lot of money. So you want to understand what your investment advisor's specialty is and make sure it matches yours, or feel comfortable that they can work with your philosophy. So questions?
Yeah, question. So if we're looking at an advisor and trying to decide whom we should try to, assuming that we answer most of the questions in regards to their style, what's a good frame of reference to use in regards to what they've done for their customers in the past? I'm thinking like, I know in some cases you look at a 10-year track record, 15-year track record. Is there some basic a basic time frame that you can look at to say, here's what I've been able to do with my my customers over a period of time?
Greg, that's a good question. And really, investment advisors really generally can't answer your question in that way because each of their portfolios is different. All their clients should be slightly different, or not slightly, all their investments should be different. So really, and this is a good thing what Cindy talked about earlier. You know, you can go online and there are thousands of articles that say what you could consider for an investment advisor. And there's usually 5 or 6 or 7 key questions that most of the good websites will show. So I think you really need to focus more on their customer service and who indeed are their primary clients. Like I said, again, if they invest mostly with people that have more than $5 million and you have $1 million, their philosophy and how they work is probably not going to fit with yours. So you probably should focus more on that, and then on their customer service. They should be able to give you, 2 or 3 references. And these aren't people that are going to tell you how much money they had or how much money they made with this particular person. What they're going to be able to tell you is they call back regularly. These people don't hide. They have good customer service. When they ask for a change in their bank account or whatever, it happens very smoothly, very quickly. So those are usually the things you're going to find out. You can ask that question, but they're not going to be able to give you the hard data probably on paper behind it. They can basically answer that question, however.
Good.
So there's
Okay.
some other questions that I think we could do. It's sort of outside of this class, but other questions, and you can do a brief internet search and find those. I know you and I have talked in some other classes, and I know you're savvy with the internet. So those are some of the things you can find fairly easily online to ask some good questions.
Yes.
Well, I
Phil.
like to say, if you have that information going in, you're probably going to have a better shot at getting the right advisor to assist you.
Correct. Yeah, you need to know some of those things that happened, and understand what the market's done for the last couple of years. Michael, I think you started to say something that looked like from my box. And
Yes.
Laura, I see you have your hand up.
My question is, this year I have about 40 grand in savings bond that matures. So on a monthly basis, I'll be getting some, cashing them out. Any suggestions as to what I could do with that?
Yeah, Michael, unfortunately, you know, I'm not an investment advisor and I don't know your entire portfolio. So I'm not going to be able to answer that directly. You know, hopefully indirectly, what we've talked about in this class is you think about if you don't have an investment advisor, you know, you think about your age, you think about your risk portfolio and how much you now have in stock and bonds. And, you know, are you going to need this money over the next couple of years? And I think you need to put all those things together and then try to come up with what is best for you. But I'm not going to be in a position to answer that question directly. The goal of this class is to help you understand the general concepts so that you can then customize them to your particular portfolio.
All right, thanks.
Sure. Laurel, you have your hand up. Laura, you're on mute if you want to have a question. Okay, Laura, if you do have a question, just come back on when you're ready. Sorry, my screen was bouncing around there. So I said I would talk about mutual funds and EFT. So EFT stand for electronically traded funds. So the mutual funds are the granddad. Mutual funds have been around for almost 100 years. So a mutual fund basically invests your money for you. They buy lots of stocks or lots of bonds or a combination of stocks and bonds, and there's thousands of mutual funds out there. They've been around, like I said, some of them have been around for quite some time. Electronically traded funds are relatively new. They've been around for about 20 years, give or take a few years. They have some similar characteristics to mutual funds, but they have some differences also. So let's sort of talk about the differences here so we can understand those. So electronically traded funds tend to have lower operating expenses. So earlier we talked about fees. Generally, the way that the electronically traded fund is set up, it usually has a lower fee than a similar type of mutual fund. So having lower fees is generally a good thing, but just something to consider. How you buy them is completely different, but it's not that important, but you need to understand. So if you want to buy a mutual fund, your broker or if you're doing it directly, will say sometime during the day, I want to buy this mutual fund and I want to buy $1,000 of this mutual fund. You do not buy it instantly. After the stock market is closed at 4 o'clock Eastern time, they then calculate what this mutual fund is worth. They're going to look at all the stocks and bonds that may be in the mutual fund and say, this is now worth whatever, making up a number, $38.17. You will then buy that mutual fund after it's completed trading for the day and what it's worth at the end of the day. An electronically traded fund is bought and sold just like an individual stock. So if you ask your broker or you go and directly buy an electronically traded fund at 2:02 Eastern time, you're going to buy it right away at that, whatever the price, whatever it's trading for at the time. The same when you sell it. When you sell a mutual fund, it's just like when you buy a mutual fund. If you ask your stockbroker to sell your mutual fund at 8:30 in the morning, it does not sell until after the stock market has closed that day. So it's a big difference in when you buy or sell it, but it's not that important because you're only going to buy once and sell once typically, or a small series of times. But I just want you to make sure you understand that difference. And generally, again, there's exceptions to every rule, but generally the electronically traded funds are considered to be more tax efficient because they are able to decrease or avoid something called capital gains. And again, just like I'm not an investment advisor, I'm not a tax advisor, I'm not a CPA. So you would definitely need to consult with your investment advisor or your tax advisor. But one of the reasons why EFTs have gained some popularity recently is because of their tax efficiency relative to mutual funds. Yes, Laurel.
Okay, I hope I'm off mute now.
You are.
Good. So this is hopefully a general question. If you're going to do a Roth conversion, I understand it's better to do that when the market is low, when you make the conversion, that you're doing it when the market is low into your Roth. But now with the market so high, I mean, it's a good time to sell, but is it still a good time to do, then put the money in the Roth when the market is so high?
Yeah. Right. So a Roth conversion is definitely a specific area within investing. And yeah, I really, there is a lot of tax implications. I will tell you this, Laurel, there are a lot of tax implications with transferring into a Roth or out of a Roth that you really need to consider, and you really need to talk to your tax advisor about that. It's even probably more important than your financial advisor. You need to talk to both of them. But that is one that is very tricky. It's got a lot of complications all the way up to, it could affect how much you pay in if you're already on Medicare. It can also, implications can go all the way up to paying more in Medicare premiums for the next year or two, depending on what kind of implications as to when you transfer into or out of a Roth. So there are way too many moving parts for us to talk about, quite honestly here. And it's just something you really need to consider. The concepts you have, I agree with, when to do it, how to do it, stock market up, down. You understand the general concepts, but you're going to have to, at least in my opinion, talk to your tax advisor and figure out a lot of other moving parts to make sure you do it correctly.
Mhm.
Now, I'm
Okay.
sorry I can't give you more, but that's a very tricky and complex situation.
Yeah, with the taxes, I figured out how much I can convert without going to the next tax level. It's just even when I Google to try and find, how to invest in the Roth when the market is up, everything is how to invest in a Roth when the market is down.
Yep.
And so I can't find anything that says, what do you do when the market's up?
Well, you're doing all the right things, Laura. You're understanding the tax, the tax brackets. You're tackling it in a good way. So it just, now it just becomes a personal decision. And, if you don't have an advisor or whatever, you just have to figure out and make a decision as to how you want to proceed now or have it go down. But you're definitely looking at some of the things. But I definitely, like I say, this is even more than an investment. It's really a big tax situation that you need to look at.
I do have one more question that maybe you could answer. Is there, if I, took the money out of my IRA, how soon do I have to put it in the Roth for it to be a conversion?
I don't know the answer to that. And again,
Okay.
a lot of tax implications. I think it's immediately, but don't quote me on that.
Okay, thank you.
All right. So Jody Lee asked also in the chat, can you please talk a little bit more about mutual funds versus EFT and active versus passive? So we did talk about the mutual funds versus the EFTs, hopefully. The active versus passive is a very good question. So basically an active mutual fund or electronically traded fund, that means that the advisor, whoever is actually managing the fund, is actively trading the stocks and bonds, thinking that they can do better than the typical person. And so they're doing a lot of analysis and saying that they think this stock's going to go up, so they're going to buy more of it, or the stock's going to go down, they're going to sell, all those things. So they're actively trying to beat the market. A passive investment, again, is, relatively new. It's been around for maybe 30 years or so. And basically it's saying that we are not going to trade. We are going to buy, they call it buy the market. So if you buy a passive fund that's the same as the Standard & Poor's 500, that's 500 stocks, you're going to buy those 500 stocks in the same rate. And then there is no active management behind it. You just hold those stocks. It has to trade them depending on how the market goes or certain details. But basically they're doing very little trading, and they're not actively looking at which stock is better or they have a feeling might go up or down more. So it's called passive. It's basically you are trading the market, or at least for that particular category. Now, if you do a little research, what you're going to find out is that most active mutual funds and EFTs do not beat the market long-term. And also the passive funds clearly have less costs, less fees, because they're not doing a lot of it investment research, et cetera. So again, I can't tell you one way or the other, but if you do a quick research on it, you will see that most, not all, but most actively traded funds end up not beating a regular passive fund, do not beat the market over a period of time. Anybody can do it for 1, 2, 3 years, but for a longer period of time, most experts are now leaning towards passive. Again, you need to make that your own decision in that, but their fees are less, and typically over a longer period of time, you will, according to the recent research, you'll be more successful with passive funds than active funds. But again, that's a decision you need to make or make with your investment advisor. So let's see. Hang on, you can see the question. I've got it blocked here. So if you want to answer it. Okay, so since, this is our last question, which is usually more tax efficient, electronically traded funds or mutual funds? So we talked about this a little while ago. You've had a lot of questions in between, and our class is just about, the hour's just about up. But if we want to see if we get so Jody Lee has already put in EFTs, electronically traded funds. So let's give a hand. She's answered 2 of the 3 questions correctly. Let's give Jody Lee a hand. So thanks so much. So, so that basically, there's some closing thoughts real quick. We've already talked about this, but you should focus on understanding at least the basics, even with an investment advisor, right? You need to understand the basics. That's what we were trying to do in this class, is help you understand the basics. You have an investment advisor, it's still your money. Nobody has more interest in your money than you, and you need to make sure you understand the basics, which is what we tried to get through today. Cost and fees of an investment is important. And like we've talked about a couple times, good investment advice is worth paying for. If you don't feel comfortable and you don't understand it on your own, good investment advice is definitely worth paying for. We've talked about it a couple times. And then make sure you understand the level of risk you can tolerate. That's what we spent a lot of the class on, is feeling comfortable. And again, with your investment advisor, based on questions, discussions, knowing your personality, they should help you understand what that level of risk is that you can understand. So real quick, we're right at the hour point. I'm sorry, but you guys have asked a lot of good questions as we went. We'll open it up for some questions in a second, any others, but basically, you know about Get Set Up. I won't talk about my other classes right now since we're a little bit time rushed. You will get an email from me, a little summary of the class. You'll also get a survey. Please feel free to complete the survey if you have a couple of minutes. I love lots of big stars, but more importantly, I love reading your comments. I adjust these classes. Like we showed that one screen that I pulled out of here because it was too complex. So, but I constantly want to adjust these classes. So I do listen to the feedback. And then finally, spread the word about Get Set Up. Please let your friends and neighbors, family know about it if you think they might be interested in that. And I want to thank you so much. And I will stay on the line if you have any other questions that we didn't get to so much. But thanks. And if you got to go, totally understand and appreciate your patience and time and the good engagement that all of you had.
Just one
So,
question.
any
Are
other
you going to
questions?
have a follow-up class? Like a next level class?
It starts to get risky then, because then you're going to be wanting investment advice, and I really can't give that. Based on Greg's question, maybe something like, how to choose an investment advisor. Maybe I can develop something along those lines, but I'm a little bit.
I'd really like to understand more about other investment like Bitcoin. Everybody's telling me to jump into Bitcoin and Litecoin, and I don't know, there's so many coins now, and I'd like to know more about like what that's all about. I haven't had the time to research it.
Yeah, it's just sort of risky because then I'm either, endorsing it or not endorsing it.
I see.
Neither
Gotcha.
one, we've got to sort of stay neutral here in regards to, the basics. I know we could try to explain what they do, but that's pretty hard to do because I'm not sure I fully understand what Bitcoin does either from that standpoint. So I've got to just be careful with that. So,
Understand. Thank you.
Yep.
Thanks for today too.
all right. Take care, Cindy. Thanks for the
All right,
questions.
bye-bye.
Anybody else have a question they didn't have time to answer during, or didn't have time to ask during the session? All right, well, I'm going to unshare my screen, and basically, if you do have a question, I'll hang in here for a minute or two. If you have a question, please go ahead and ask it, and then if not, we'll close out the session. But I definitely appreciate everyone.
Thank you.
Thank you, Henrietta. Thanks for joining.
Thank you.
All right, I'm going to go ahead and end the session now. Thank you, everyone, for attending, and hope to see you in another class.
Thank you.